The Sharpe ratio is the most misused metric in finance. Two strategies can have the same Sharpe, yet one is a steady earner and the other is a time bomb. We'll show you why the assumption of normal returns breaks down, and how leverage can fake a good Sharpe. Every Sharpe ratio calculation starts with a hidden assumption: returns are normally distributed. That means the metric treats gains and losses as symmetric and ignores extreme events. But financial returns are not normal. They have fat tails and skewness. Fat tails mean extreme moves happen more often than a bell curve predicts. Skewness means losses and gains are not mirror images. This single assumption is why the Sharpe ratio can be dangerously misleading. Consider two strategies. Strategy A wins 99.9% of the time, but in the rare 0.1% case, it loses everything. Strategy B wins 99% of the time, but the 1% loss is small. Both can have the same Sharpe ratio. Yet one is a slow bleed, the other is a catastrophe waiting to happen. The Sharpe ratio cannot tell them apart because it ignores the shape of the return distribution. Skewness measures the asymmetry of returns. Positive skewness means you have frequent small losses and occasional large gains. Trend following often has this profile. Negative skewness means frequent small gains and occasional large losses. Selling options is a classic example. The Sharpe ratio treats both the same, but they have completely different risk profiles. Positive skewness is like collecting pennies in front of a steamroller, negative skewness is like selling insurance. The Sharpe ratio is the average excess return over the risk-free rate, divided by the standard deviation of returns. It tells you how much return you get per unit of total volatility. But standard deviation treats upside and downside volatility equally. That's a problem when your returns are not symmetric. Here's the counterintuitive part: you can artificially boost the Sharpe ratio by adding leverage. If you borrow money to increase position size, your returns scale up linearly, but volatility also increases. However, the Sharpe ratio can actually rise if the risk-free rate is low. Let's see the math. In theory, leverage doesn't change the Sharpe ratio because both numerator and denominator scale equally. But in practice, leverage introduces financing costs, margin calls, and the risk of forced liquidation. These costs eat into returns and can turn a mediocre strategy into a disaster. The Sharpe ratio you see after leverage is often an illusion, hiding the true tail risk. The Sortino ratio fixes one of Sharpe's flaws: it only penalizes downside volatility. Instead of standard deviation, it uses downside deviation, which measures how much returns fall below a target. This gives a clearer picture for strategies with positive skewness, like trend following. The Calmar ratio compares annualized return to maximum drawdown. Maximum drawdown is the largest peak-to-trough decline in equity. This metric directly addresses tail risk because a single catastrophic loss can wipe out years of gains. Calmar tells you how much pain you endure for the return. A professional evaluation should never rely on Sharpe alone. You need at least 6 metrics: Sharpe for overall risk-adjusted return, Sortino for downside risk, Calmar for drawdown, Skewness for asymmetry, kurtosis for tail thickness, and maximum drawdown duration for how long you might be underwater. Each metric captures a different dimension of risk. Together, they give a complete picture. Here's a quick comparison of the key metrics. Sharpe uses total volatility, Sortino uses downside deviation, Calmar uses maximum drawdown. Each has a different focus. Skewness and kurtosis describe the distribution shape. Max drawdown duration tells you how long you might be in the red. The Sharpe ratio is a useful starting point, but it's not the whole story. It assumes a world that doesn't exist. Real returns have fat tails and skewness. Leverage can hide risk. If you're evaluating a strategy, don't just look at the Sharpe. Look at the distribution, the drawdowns, and the downside. Use Sortino, Calmar, Skewness, kurtosis, and max drawdown duration. That's how professionals avoid the Sharpe trap. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.